Are you ready to turn economic downturns into golden opportunities? Imagine having the inside scoop on how to grow your wealth even when the market seems to be crumbling around us. What if I told you that you could learn from none other than the investment legend himself, Warren Buffett? Yep, that's right. In this video, we're diving deep into Unlock Buffett's Recession Wealth Secrets, a treasure trove of strategies that have not only weathered but thrived during the toughest economic times. We're not just talking about making it through the storm, we're talking about sailing ahead with more wealth and wisdom. Whether you're a seasoned investor or just starting out, these insights are your key to unlocking potential riches during periods most people fear. Stay tuned as we reveal how to make the most of your investments, why downturns can be your best friend, and the secret moves you can make today to set yourself up for success tomorrow. Trust me, by the end of this video, you'll look at recessions in a whole new light. Please subscribe to my channel and please like this video. Let's decode Buffett's secrets together and transform economic challenges into your financial victory. Are you in? Let's get started and change the way you see investing forever. So, what's the first step? Build a safety net. This means saving up enough to cover big things like your home and food for at least 3 months. Got that? Why not aim for 4 months? This safety cushion means you won't need to touch your savings or investments when things get tough. Keep this in mind because we're about to explore why it's so important. After setting up your emergency fund, the next smart step is to clear any high-interest debt. Imagine having no credit card debt when tough times hit. Losing your job during a downturn without that monthly bill will feel like a breeze. Plus, clearing this pricey debt quickly means you'll pay less interest, making it a win-win. And now the second step, right from Warren Buffett's treasure chest of wisdom. Make yourself better at what you do. With the possibility of a tough economy in 2024, companies might start cutting costs, and that often means jobs could be on the line. To make sure you're not on the chopping block, you could learn new stuff or kick off a side hustle that brings in some extra cash without taking up all your time. This approach gives you another way to make money, which can boost your savings or help chop down your debts. Plus, it acts like a backup plan if you end up losing your main job. Next up, let's look at some smart moves for making money during a recession, starting with bonds. Bonds can be a clever pick for earning some cash, either by holding onto them until they're paid back or selling them for more than you bought them for. When the big company Berkshire Hathaway showed off its earnings for the third quarter, it surprised everyone with a smart play. They were selling more stocks than buying, like their shares in Hewlett-Packard and Chevron. This move bumped their cash up to a record $157.2 billion. But the real eye-catcher was Warren Buffett and his crew tossing an extra $29 billion into short-term US Treasury bills. Now, this was a curveball, because Mr. Buffett usually isn't keen on putting money into long-term bonds. He's always believed that over time, stocks and other investments beat bonds. So, why the shift to government bonds? Knowing Buffett, he probably saw this as a savvy way to park some cash while waiting for a better opportunity to come along. Turns out, during shaky economic times, putting your money in government bonds is a pretty safe play. When the economy looks uncertain, folks start moving their money into these secure options, driving up demand. This boost in demand can also push up the price of bonds. So, if you sell these bonds, you could end up making a nice profit quickly, because you're selling them for more than you paid. Thinking of taking a page from Mr. Buffett's book? Investing in government bonds during a downturn might just be a smart move. Following Warren Buffett's genius plan of keeping risks low, having cash on hand, and waiting for the best opportunities to grow your money, investing some of it in stocks is a wise strategy. But hang on, you might be thinking. True, when the economy takes a hit, stock prices often drop, and that dip might linger. But believe it or not, these moments are actually golden opportunities for investing. Not convinced yet? Let's grab a piece of advice from Warren Buffett himself. He reminds us that market dips are just a part of the journey for long-term players. Since 1929, there have been 22 major market downturns, with stocks plunging by 20% or more. The time to bounce back varies, but one of the best ways to build wealth during a recession is to invest as much as you can in the stock market. When the economy takes a dip, folks tend to spend less, businesses earn less, and investors start to worry. Some sell their stocks because they're scared or need the money, making it the perfect time for those with some cash to invest. It's like everything's on sale. If the price of a stock goes down by 25%, you can snag it for 25% cheaper than before. So even though it seems risky, buying when prices are low can lead to big wins when the market makes its comeback, which it always does. To see how this works, let's look back at the three big economic downturns before the COVID-19 pandemic. The Great Recession from 2007 to 2009. The 2001 recession caused by the dot-com bubble burst and the 9/11 attacks, and the early 90s recession after the booming 80s. In each of these tough times, folks who invested when the market was at its lowest saw incredible growth over the long term, even if their timing wasn't perfect. Anyone who jumped in during these dips ended up doing really well. Following Buffett's playbook of minimizing risks, keeping cash ready, and looking for the best growth opportunities while waiting for the next big chance, it's smart to consider investing in stocks. But hold up, you might be thinking about the risk, especially since stock prices usually fall during economic slumps and might stay down for a while. However, these periods often offer the best investment opportunities. Still skeptical? Looking at the last three major recessions before the COVID-19 pandemic, we see that investing at the market's low points can lead to significant long-term gains, regardless of timing. Anyone who invested when prices were lowest ended up doing well. But remember, trying to guess the market's lowest point is nearly impossible. You can't know for sure when it will hit rock bottom. And the great news? You don't have to get the timing exactly right. For instance, if you had invested in an S&P 500 index fund just before the 2008 crash, you'd have seen an average annual return of 8.4% over the next 13 years. Following the early 90s recession, a $10,000 investment with dividends reinvested would now be worth over $150,000. Essentially, investing in stocks during a recession is a long-term bet on the success of US businesses, which historically has been a pretty solid bet. Instead of trying to hit the jackpot by guessing the best time to jump into the market, there's a smarter way called dollar cost averaging. This means you put in a certain amount of money regularly, which lets you grab more shares when prices are down and fewer when they're up. But before you leap into stocks, remember three big rules. Have a solid emergency fund that can cover 3 to 6 months of your bills. Don't invest money you'll need soon. And brace yourself, because investing during a recession can be a bumpy ride. Watching your investments drop right after you buy them can be tough, but the secret to winning big is thinking about the long game. And that leads us to our third big tip. Resist the urge to obsessively check on your investments. When the economy's in a slump and the stock market's doing the hokey pokey, it's really tempting to check your investment account every single day. But if you're putting money into stocks during a downturn, that's a no-go. The more you stare at your investments, the more you might start to panic. And panicking can lead to making hasty choices that might end up costing you a lot. So, if you're not ready to stick to these rules, maybe consider bonds or our next idea, putting some of your money into precious metals like gold. Gold might not get your heart racing like bonds or stocks, but there are solid reasons why lots of smart folks recommend buying gold before a recession as a way to make some cash. Just like the safety net that makes government bonds appealing, gold usually keeps its cool or even climbs in value when times get tough. Plus, gold is a great way to diversify your investments and spread out your risk over different kinds of assets. Think of it as your financial safety gear. While stocks might be taking a nosedive, the steady or rising value of gold can help balance things out or even make up for those drops. For example, the investment experts at Schroders found that during recession, gold often outperforms the S&P 500 by 37%. Gold is also a champ at fighting inflation because it's been valuable for ages. When the economy feels shaky or inflation is climbing, folks often flock to gold to protect their wealth. Unlike cash, which can lose its value, gold tends to hold on to its buying power, making it a wise pick in uncertain times or when you're worried about money losing its value. And here's another cool thing about gold. It's always in demand because it's rare. Unlike some investments, like houses, you can turn gold into cash pretty quickly if you need to, whether it's because of a job loss or an unexpected expense. So, if you're on the hunt for a reliable asset that can help you ride out the economy's roller coaster, gold might just be the ticket. Thank you for joining me today. If you found value in our time together, please like, share, and subscribe for more insights on living richly on less. Until next time, keep making smart choices and let's turn those dreams into reality.